McDonald's is facing their worst crisis since 2009, and this is a huge warning to the world because we just got new evidence that two major economies are experiencing some major problems, and what we're facing now is a global economy that could be McDoomed. Now, let's turn to Bloomberg, where he picked today's story up, as McDonald's is cutting prices of its combo meals to convince customers it's affordable again. Now, you might remember post-pandemic when McDonald's came out with their $5 value meal deal, I said this thing was not going to be temporary, and McDonald's was clear. This is just a limited time deal. They haven't canceled it. Now, the issue we've been saying is that consumers continue to fall behind due to inflation, and now McDonald's is starting to feel the pain. Right now, they're facing customers that aren't even coming in for breakfast. The situation is getting dire. McDonald's and its U.S. franchisees agreed to price 8 popular combo meals at 15% less than the total cost of buying these items separately. And they'll also expand their combo offerings with a $5 breakfast deal and an $8 Big Mac and McNugget special. And the prices at some of these restaurants are getting absolutely outrageous. Now, the other day I had to run up to the store. I didn't have anything to eat for dinner, so I thought I'd run into Jersey Mike's, and I haven't been there in years. I was completely shocked that a sandwich is $12. And I can only imagine the sticker shock that people are facing at companies like McDonald's and a lot of other fast casual chains. Because as we look at the broad economy, the situation for the average consumer continues to get worse. And yet at the same time, what are we facing? Rising price pressure. But when we talked to the CEO of McDonald's, this is what he had to say. The single biggest driver of what shapes consumers' overall perception of McDonald's value is the menu board. And that's exactly my expression when I heard that. It doesn't make any sense because they think that for some reason, if people come up and see a great value menu, that they're going to come in and spend. The problem right now is that consumers are facing a lot of headwinds. It's not just the economy. It's not just the fact that their hours worked are dropping. Remember, we've talked about how this summer, what are we facing? Really high energy bills, and this is taking away from discretionary spending. On top of that, millions of Americans are going to face having to start paying on their student loans again, and this is a major problem. And McDonald's is now at the forefront warning that we're seeing a downward slide in consumer spending, one they think is simply solved by a better value meal. And fast food breakfast sales fade as diners eat at home and are skipping meals. And again, this is a major red flag for the economy because when you think about it, when things are booming and people have work and they need to do things, they slide in, grab their breakfast on a fast food basis, and then go about their day. And right now, McDonald's is saying, look, people aren't coming in and buying breakfast anymore. This is the worst that they've seen since the financial crisis. But the real issue, my friends, is not just isolated McDonald's. It's something that we're seeing all across a lot of fast food chains. Consumers are becoming even more cash strapped. But something that you shouldn't have to be cash strapped about, that is your trading account. Let's talk about this trade we put on to all of our subscribers back on the 21st on GDX. It's large gold miners. We told them to buy the open. And again, this came from our new Metre strategy. It's up as it closed the business yesterday, 3.46%. And over the weekend, we told our subscribers, hey, it's time to raise your stop losses on this trade and lock in some of those gains. Now, if you want to get in on our Metre strategy, if you want to know how to change the way you trade, stay tuned to the end of the show or grab those links in the description and the coupon code for your free 30-day trial. Because as I said, it's not just McDonald's. Let's talk about Wendy's because the consumer uncertainty increases and consumers choose to eat another meal at home. Breakfast is often the first place they do that. This according to Ken Cook, the interim CEO, and he's absolutely right, particularly if people don't have a job to go to or they're not getting the hours they need. They look at their finances and say, you know what, I'm either going to skip breakfast altogether or I'm going to eat at home. And again, this is just a symptom of what we're seeing as a broader issue that's facing the global economy that is continuing to slow down, paychecks are continuing to shrink, and people are getting more worried about their finances. And again, what we're seeing here, major headwinds for U.S. consumers. Let's take a look at this chart of average weekly hours of production and non-supervisory employees against the delinquency rate, because what we're seeing in the economy is people are running out of money. And that's a problem when you're in a debt-based economy, because you need the constant expansion of debt, not only to pay on existing debt, but to fuel growth. And as economies slow down and banks constrict their lending, well, there's less money in the economy. And here is the evidence of that. Because what we're seeing at the same time is a slowdown in average weekly hours. This is exactly what McDonald's and Wendy's are seeing. At the same time, you see a rise in delinquency. Again, people cut back their spending. And notably, 94, this is the year I graduated high school, that was the year that everyone said the economy saw a soft landing. But there's a major problem here. Normally, we see this relationship, it indicates we're heading right into a recession. And that's the risk we're facing right now, is workers are not getting the hours they need to pay their bills. They can't afford to eat out for breakfast if they want to. And the risk is we're going to see the delinquency rate rise even further. And of course, they blame low-end consumers. They're saying their budgets are cash-strapped due to the cumulative impact of inflation. The pullback on breakfast spending is worse blow for Wendy's than its rivals, saying that they're dumping money into marketing to get people to spend. But the problem isn't that Wendy's isn't doing enough marketing. The problem is, and it's not just limited to lower-income people. We're hearing that middle-class people are struggling. Even high-income Americans are falling behind on their credit card and auto loans. And when you're in that situation, you don't eat out as much. And that's the problem that a lot of these restaurants are going to face. They're going to have a lot less foot traffic and a lot more competition. And this is exactly what's happened in China at the manufacturing level. In fact, the government's been complaining about this. The businesses are competing on price and they're dropping their price down. And we said that's exactly what's going to happen here. And now we're seeing it in the fast food space. And you can see that as weekly hours decline, inflation becomes a foregone conclusion. Let's take a look at this chart here of average weekly hours of production, non-supervisory employees in blue against the consumer price index. And we can see clearly where the problems begin here for consumers. We're back around 2022 because hours were dropping. At the same time, inflation was rising, staying high. But again, what happens is hours drop and spending drops, inflation comes down. Now the issue is, again, you've got high electric bills, you've got the resumption of student loan payments, and inflation is still running too high for most consumers because they had to take on debt to get through that period. And what they're facing now, on top of everything else, is high debt service costs. And what this tells me is we're facing an all-out crisis that's going to hit the global economy, and we are seeing further evidence of that as we now turn to Canada. As Canada consumer spending falters as July sales decline. An advanced estimate suggests that receipts for retailers fell 0.8% in July, following June's 1.5% jump. So what we saw in Canada is kind of spending was pretty lackluster. It jumped kind of as an indication of front running the tariffs, and now it's collapsing. You know, remember, we've been talking about how this is really going to start showing up in the data at some point. Now, I thought it was going to happen a couple months sooner, but due to all of the pushback on the trade war and delays that happened with that, what we're facing now is this deal is looking like it's done. Prices are going to be going up, but the problem is demand is going down at a faster rate. When that happens, well, you don't get higher prices. You have businesses like Home Depot and Walmart saying, look, we're trying to sneak in price increases where we can, but overall we know we can't keep raising prices because consumers can't afford it. And when they can't afford it, they cut their spending, which is exactly what's happening at McDonald's and Wendy's. This is consistent with a generally more cautious attitude among consumers to spending amid tariff uncertainty, particularly compared to the solid growth seen during the second half of 2024. This is from Andrew Grantman, an economist with Canadian Imperial Bank. And Andrew, I don't agree with that at all. I don't think it's about uncertainty. I don't think that consumers are saying, you know what, I don't want to go out and get a sausage and egg McMuffin because I'm uncertain about the economy. They look at their finances and say, you know what, I can't afford to spend $5 on these things. He added that it isn't the sort of consumer spending that should worry the Bank of Canada policymakers from an inflation point of view as they debate whether to cut interest rates further. And that part he's right about, because as I showed, when you see spending go down, inflation falls. And again, it all comes back to paychecks. It's not about uncertainty. It's not about economic uncertainty, so to speak. It could be about the labor market uncertainty. People are worried they're going to see less hours. They're worried they're going to lose their job, and they're worried they're not going to be able to get another one, and that is why they're not spending here. And the evidence is clear. As retail sales go down, as you see paychecks go down, what happens? Inflation goes down right alongside with it. Let's take a look at advanced retail sales in blue, overlaid against the consumer price index in red. And you can see every time that the consumer price index is going down is because retail sales are declining. Now, this doesn't happen every time, but you can see it's a very consistent relationship. So as we look at the fact that policymakers think inflation is likely to rise, well, the fact that retail sales are rolling over suggests just the opposite is happening here. The data highlights gradually slowing household consumption amid tariffs and heightened economic uncertainty, despite significant rate cuts from the Bank of Canada. Now, what does that tell us? Well, it's not about uncertainty here. It's about rate cuts and the magical power of them, because remember what these central banks want you to believe, that if they just drop interest rates, then consumption rises. And guess what didn't work in Canada? Because rate cuts do not have any power here. And here is the evidence. Let's take a look at average weekly hours of production of non-supervisory employees multiplied by average hourly earnings, or what we call total income, against real or inflation-adjusted retail sales, that in red. And what do you see? As paychecks go down, sales go down. So it's not about rate cuts. And you can see this relationship consistently over the years. And that's exactly why we see retail sales are rolling over here, because when you look at incomes, they're rolling over. So you'll note that consumers, when they think about going and buying a value meal at McDonald's, they're not wondering, well, you know what? If the Fed cuts rates in September, I could afford this now because things are getting better. The bottom line is they look at their budget, they look at their bank account, and they realize they cannot afford these high prices. But it's not just Canada. The spillover is now into South Korea as they see their economy performing at the weakest since the pandemic shock. And statistics for the first 20 days of August showed that exports to the U.S. fell 2.7%, indicating a loss of momentum after they rose 1.4% in the month of July. So now we can finally see that we're getting into the beginning of that payback period that we warned about. We said due to all the front loading from the pandemic and due to the trade war, it would eventually hit the global economy. And again, I thought it was going to happen a couple months earlier, but now it appears that it was in July, and we're facing the payback period now going forward. And again, my friends, this is going to get ugly. Korea remains heavily reliant on exports, raising risk as it confronts rising protectionism abroad. It also faces structural challenges at home, including weak construction activity and elevated household debt. So you tack on the fact, and again, you look at the American consumer here who has rising delinquency rate, but you look at South Korea, consumers have rising debt. Well, we have this too, and so do consumers all over the world. And the problem is they're paying relatively high interest rates on this debt to service it. Again, it's all pulling money out of the discretionary side of the economy. But I think the policymakers there, I think they're completely confused about how this plays out. Employment is forecast to rise by 170,000 this year in Korea, with gains in services offsetting losses in construction and manufacturing. Inflation is seen hovering near the central bank's 2% target as energy prices decline, though the government warned that geopolitical tensions and erratic weather could reignite price pressures. And again, I think they're in complete denial here, because we've talked about, and I've shown you, where manufacturing goes, the services sector falls. And here they think, okay, hey, it's no big deal. We're an export-led economy, and manufacturing is going to dip. But our services economy is just going to turn around and boom. The reality is, I think the exact opposite is going to happen. I think we're going to start seeing layoffs over the next couple of months happen in every major economy all across the world. But let's turn to the Fed, whose Goolsbee is now lauding Powell's management of a fractious FOMC. Now, what is he referring to? What is Goolsbee talking about? Well, when you look at the board and you look at dissents, Powell has had double the amount of dissents compared to prior Fed chiefs. And this is a major problem, because a Fed chief gets what they they want in the end of the day. They set policy. It's not a consensus. But what the Fed chief wants is its members to go along with whatever it is they want. So Powell's got a major problem here. He knows that if he doesn't cut rates in September, he's likely to face further dissent. And Powell delivered his final Jackson Hole speech as the central bank's chief on Friday, opening the door to a September rate cut. His term expires on May of 2026, but if you think it's going to work, it's not. Let's take a look at advanced retail sales against the federal funds rate in red. And what do you see as retail sales decline? Again, it's all about paychecks, my friends. Rate cuts don't work because remember, rate cuts can't work if people are out of work. Remember, if you ever gone and tried to get a loan and they say, well, where do you work? Say, I don't have a job. They tend to not give you a loan. And when you put this all together, this is exactly how I feel. Of course, this is how AI imagined me as the hamburger. And now let's talk about your trading account here, because this isn't how you should look at your screens, because when we have our meta strategy, it is going to change the way you trade. Now, what is it? It's an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It provides 31 more frequent buy signals than individual strategies while maintaining high quality through multi-strategy consensus. It pulls in the Bravo 9, Turtle Trading, 200-day moving cross, golden cross, trend pullback, RSI divergence, 520 EMA cross, channel trading, and Fibonacci retracement, and it's doing this to optimize for swing trading. It's got a target hold period of 2 to 15 days, generates over 155 signals per year, and has a success rate with 55% that includes fast profit taking. Again, optimized for swing trading, and it's going to get better because right now I'm in the process of optimizing each of those strategies to maximize their return potential. And again, right now it's included in either of our subscriptions at no additional charge. Now you get the daily report, whether you want to trade against the machines, that's our CTA Timer Pro. You want to trade momentum signals, that's our Momentum Timer Pro. You get the tradable signals. You get my opinions on the best trades. We give you risk control levels, a full tracking of all our open trades and returns, a weekly update. And again, in addition to the meta strategy, our best part of all of this is you get a free 30-day trial. It means you can try out any of our reports and the meta strategy for 30 days on me. How do you do that? Grab those links in the description below. Use your coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.